moving onto sort of QE and perhaps, as we were talking before the interview, potential for QE3 in this country, there is no doubt growth is slowing dramatically. Markets are beginning to...
In the US, growth is slowing.
Yeah, globally. I mean,
yeah.
the periphery of Europe, even Germany now is starting to slow. That's an export market. It's the impossible trinity, isn't it? It's the economic trilemma where you can't control capital controls, you can't have your cake and eat it on monetary policy and FX controls as well. What we're seeing is everyone's trying to graze from the same bin, and obviously growth is slowing, and some people are going to get a bit more of the grazing, but not everyone's going to be able to keep their growth up. So growth is falling. The US clearly is going to come back, in my opinion, to some form of QE3. Unfortunately, I think that they will probably do something like buying long-end bonds, which actually I think will have, it's a very inefficient way of trying to transmit money into the system. Obviously, I don't approve of it as someone who doesn't believe in dilution of your currency, but in the current system, if they want to create aggregate demand, I think what they should be doing is, I don't approve, but if I was Ben Bernanke and I was thinking about this, I would be wanting to stimulate the householders, because clearly they need to get rates down for these individuals. And how do you actually do that? Maybe you make reset on mortgages, FHA loans, etc. Maybe you make them cheaper. Maybe they're going to go and buy commercial real estate, but it'd be a qualitative easing, not a quantitative easing.
Yeah, but I mean, that's not going to solve the problem, is it really? And the other thing you're doing is you're just destroying the savings, you know, the middle class and the capital that they've accumulated.
Yeah, so you and I are on the same boat on this, and I think this is what we should take out. This is what they would like to do, not what we would like to see happen. The reality is what's happened in Europe. Take the EFSF and what's going to become the ESM, Exchange Stability Mechanism, in 2013. We've seen a huge fiscal transference. We've effectively got a fiscal supranational entity there that has taken over monetary policy, and they will be able to print unlimited amounts of money to recapitalize the banks, obviously with funny money, and they also will be able to bail out the bond markets. They will be able to buy bonds in the market. I mean, we saw today.
But as we both know, that's not really recapitalizing, because it's not coming from savings, it's coming from money printing.
And this is the problem. We have already spent our capital that's been available to us, true capital that was created through the private sector, because we've had such an over-leveraged system in order to pay for Social Security, Medicare, and other such liabilities. I think going forward, if we continue these policies, there is no doubt that we are going to get to one of what Mises, the Austrian economist, said is a crack-up boom. I am in the camp at this point that should they come back to the markets with some form of qualitative easing or quantitative easing, that we will only accelerate. And I think it can happen a lot quicker than people think. People talk about even those who are very doom and gloom on the paper currency system believe it can stretch out 5–10 years. But I think we're getting to a point where it's almost self-fulfilling. The more people discard each currency, from the euro, Swiss franc, we see them intervene today, that's going to have people thinking about the Swiss franc. Do I want to be in yen? No, they're intervening in that. Everyone's selling each currency. And every time they discard a currency and go into gold, it's an inverse function. And of course, the more you do that, the more gold goes up. And so it becomes self-fulfilling, and that's a positive feedback.
Was this part of your thinking when on King World News recently you were talking about $2,000 gold here in the not too distant future? That we're starting to get that self-fulfilling, you know, feedback loop that as the gold price goes up and as more government intervention occurs in the currency markets, more people are going to move to gold? Yeah,
and I definitely want to state that this is not. This self-fulfilling prophecy here is, at this point, it's not a destabilizing moment for gold. It's a destabilizing moment for fiat currency. Yeah, I do not believe that we've got the precursory patterns for a bubble in gold. That's not what I'm saying, and people are trying to label it as such. I think also I have a sort of trader's viewpoint on this. We were breaking out to nominal highs at a point where, other than Swiss francs and yen, which were all at very extreme levels already, where do people have to go? I think it dawned on people. In fact, I think I have friends who obsess about the validity of the credit system as it stands, who've never been interested in money. in terms of what it meant to them and a day's labour and what is the value of a pound. They just assume that they get a cheque and, hey, I can go and spend this. And when you have people like that who start to really worry about the financial system and actually say to you, well, what currency do you go in? And it all leads back to gold. And I think that's where we're going. From my trader's point of view is, as we break to new highs, who's wanting to sell the gold? We have not moved auction to a price high enough to find a long-term holder of gold who's said, in this environment, I'm prepared to sell out and go into something else.
Sell gold and take paper.
Or take paper, or take something that gives you a rate of return in a paper currency. Now, if I was to, maybe if I was a brave man, some people will say, good discount on Greek bonds. But I know this is only the just beginning, as you do, for the European Union, or perhaps the breakup of the European Union. And I think it could come down to that. And in fact, I maintain that that will happen. At some point in our career, if we don't have a gold standard brought on by China or even the US, if they want to maintain, if they have the gold, which, as we all agree, we suspect they don't. If we don't have that standardization, at some point in the next 10 years, maybe even sooner, there will be some real assets to sell out of at much higher prices to buy paper assets with a much higher yield or discount that gives you that comfort and safety. Maybe it's like in 1980, long bonds at 20%. Maybe we get that opportunity.
Yeah, markets eventually move to extreme where something becomes so overvalued and something else becomes so undervalued that disparity just can't exist, and the market ultimately clears it by bringing down the price of the overvalued asset and bringing up the price of the undervalued asset. And we see that in financial markets all of the time. But the point with regard to gold is that even, I'm agreeing to what you're saying, even though the price is high, the value of gold is still quite good at the moment.
That's a great point, yeah. And I keep saying that's a great point. But they're two distinct constructs. Price and value. Price is the level at which you exchange, and value is whether it's worth it. And hopefully I've articulated that correct.
And in this Bretton Woods II system, price is even harder to determine accurately, or because of the fact that currencies and central bank intervention, you have all of these huge imbalances and whatnot. It makes the value of the currency that much more suspect. It's like having a measuring stick that's constantly changing, and you are giving a carpenter a yardstick, which is varying, and
extending it.
Yeah, or in the case of currency, shrinking it. In terms of loss of purchasing power.
Yeah, no, that's a great analogy. I think when you debase the numeraire to the extent that we're seeing now, is how do we ascertain what true demand is? Asia clearly has a growing economy, and this is the positive side of what's happening in the world. We've got this booming demographic, but it's accelerating on an illusion of a standard of living because of all this money. And people will say, well, standard of living is so much higher. Unfortunately, we've spent our available capital and we have taken from future generations. And unfortunately, it's going to come back on us now, not my children and their grandchildren. It's going to happen in my lifetime, in your lifetime. And that demographics, though, that we're seeing that boom, how much is that real demand? How do you value that? It's very difficult. What is the value of a barrel of oil? Should it be 80? Should it be 10? If we divide by the denominator, just cut it by 10, or divide the numerator, slash it by 10, we can bring everything down, and that's effectively money, as we all know, is like any other commodity. It has a supply and demand.